These macroeconomic charts will blow your mind. Let's dive right in. First up, the economy is collapsing before our very eyes. And this is proven across a variety of metrics, including the Richmond Manufacturing Expected New Orders Survey, collapsing well past the pandemic low, collapsing well past the 2009 financial crisis low, hitting an absolute record. So manufacturing is at a standstill. National Home Price Index collapsing, 3-month annualized growth rate plummeting faster than any time since 1997. Look at that deceleration. Home prices are collapsing. And we know exactly why that is, because the Federal Reserve is pumping interest rates up to historic highs to fight inflation. And so you have the cost of mortgaging the average US house skyrocketing. And it just shows how historically massive this is. These are extraordinary times. This is the year-over-year growth in the mortgage rate. So just absolutely huge. In the last 100 years, we've never seen anything like this. So houses are completely and utterly unaffordable. Something is going to break. Every single time the Federal Reserve pumps up interest rates, something collapses. It's like clockwork. This is the fastest acceleration in US history, except for maybe one or two periods in the 1970s. So we can expect some more carnage. Now, again, is what the Federal Reserve doing working? Remember, their goal is to kill inflation. Well, we do have a collapsing natural gas spot price in Germany. So there's been this energy crisis in Europe due to supply constraints around natural gas and fossil fuels. And so we had a massive inflation spike in the middle of 2022. And we can see in this chart, that spike has gone away. This is the movement directionally of the natural gas price reaching negative levels. And it just goes to show that inflationary pressures have eased up temporarily in Europe. Here is the actual benchmark Europe gas future plummeting from its high. We've seen plummets like this before all throughout the 2021, 22. We've seen these spikes up and then spikes down. The real question is, what is next? We can't have global systemic stagflation and inflation and expect the Federal Reserve to lower rates anytime soon, which will save markets. And then we have this. This is just absolutely fascinating. This comes from Alessio. This is the contracts spread futures for gasoline, jumping the most on record, signaling a shortage. And so we know we've pretty much used up just about all diesel fuel supplies in the United States since they've dipped into the reserves. And so, yes, it's worked. It has lowered the cost of fossil fuels in Europe. But then we have headlines like this. The US has just 25 days supply of diesel, but more is coming. The Energy Information Administration has revealed that the US supply of diesel is at its lowest level since 2008, and that the 4-week rolling average in demand for diesel has risen to its highest level since 2007. Stockpiles have been drained due to Russia's ongoing war in Ukraine, which has tightened global supplies and limited imports. Additionally, refiners have entered maintenance season. And so this chart speaks volumes about the inventory deficit of diesel. US Big Three, crude, gasoline, and distillate inventory deficit compared to the 4-year average. And so just seeing a massive drawdown in inventory supplies. And so in prior videos, we talked about how inflation expectations are all priced in to come down in the middle of 2023. That's when the bond market believes that rates will finally come down. And so inflation expectations have been wrong for the last year, at least year and a half, 2 years, completely and utterly wrong. We'll see if they continue to be wrong. Lots of moving pieces, just showing you the charts so you can know exactly where we are right now. Now let's look at sentiment, market sentiment. This matters a lot, right? We know markets are manipulated. We know it's a big casino. We know that when everyone is crowded in one direction, everyone gets squeezed out of that positioning. So let's just take a look at market sentiment. Always crucial to stay on top of this. This is the S&P 500 put to call premium, meaning how expensive are puts compared to calls. A put means you're short the market. A call means you're long the market. And so when puts are expensive, it means there's high demand for puts. People want to be shorting the market. That tells me that we're ripe for a short squeeze because there are too many shorts out there. And you can just see historically, Whenever this thing spikes up, people get squeezed. Now, it's never as simple as that, because let's look at this chart too from Sentiment Trader, showing that while yes, percent showing excess pessimism right now is at a super high level historically. You can just see back in 2008, we had many periods like this leading up to the great meltdown in stocks in 2008. So it doesn't mean that there isn't further to fall, but it definitely means that the market is getting tighter and tighter, and that if it does fall further, then the short squeeze is going to be even more epic on the other side. Sentiment, absolutely huge. Here is another fascinating look at the sentiment of the market, not so much in stocks, but in bonds. Bulled up on bonds. TLT call open interest soars as puts shrivel. So people are bullish bonds. This is fascinating because you have people short the market, the stock market, but long bonds, which means that everyone is starting to think that rates are going to come down, that inflation is peaking. Again, everyone is generally wrong when it gets skewed in one direction. So if this trade goes south on all these people chasing bonds, then what's going to happen is rates are going to spike up. And so could there be an inflationary shock, a scare around the corner that causes rates to spike even further? Will the Federal Reserve continue to just pump up rates, which would just continue to crush bonds and hurt all these people in bonds? Very possible, very complex what is going on. Here's another look. Massive and accelerating Bank of America private client inflow to bonds. So everyone just trying to dive right into bonds, probably realistically at the wrong time. You always have to fade the herd. Now, this chart is absolutely fascinating. This is the balance sheet as a percent of GDP. This is the central bank's balance sheet in each of these countries. You have the Bank of Japan in green, you have the Swiss National Bank in pink, you have the ECB, European Central Bank, in white, and then you have the Federal Reserve of the United States in yellow. And so this says a lot about what is going on. We know all these central banks are printing money and buying up bonds, right? Left and right. And so the Bank of Japan now has 125% of its entire GDP, its entire economy, in printed money via bond purchases in its massive balance sheet, right? The European Central Bank is 80.9%, but the Federal Reserve only has 34.6%. And so you guys tell me what you think. A lot of people think the US is about to enter a hyperinflationary phase where we're in a printing money debt spiral, when the reality is we're still the cleanest shirt in the dirty laundry basket, and there's still more upside. So the Federal Reserve can absolutely continue to, in theory, according to this, there's more room for money printing. We're not quite at the end stage because every one of our competitors is way worse off than we are. And so it does speak volumes if you're a long-term investor just waiting, riding out this economic turmoil because the Federal Reserve is raising rates temporarily. They can't raise them forever. And so what's going to happen is once this pivot happens, there will be more room to the upside in risk assets. At least that's what this chart is saying, but let me know what you guys think, because there are lots of strong opinions about this, but it is hard to argue. Where every single one of our competitors' central banks have over 80% of the entire economy on their balance sheet, and the US only is 34%. It just means we're still the strongest in the world. The US dollar is still the strongest currency in the world. There is still more room to debase this currency. And again, if you're a long-term investor, that should excite you. Because while no one is a fan of printing money, you have to play the cards you're dealt. We are in a centrally planned and manipulated economy. You can't fight the Fed. Right now, trying to fight the Fed is difficult because they are crashing markets and crashing the economy. What happens when that turns around? We will continue to stay on top of this market. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.